Hey everybody, Chris Englebert with Englebert Financial Advisers in Allentown, Pennsylvania with the weekly QDEC Rotella update. This week, we are going to be talking about the March update for strategy. Now, I know we typically do that the first week in the month, but last weekend I was in the beautiful city of Austin, Texas at an investment conference, at a conference I actually haven't been at for 2 years because of the pandemic. They held it. It was really good, and I'll share some of the insights that we derived from that. So let's get into it. I know this is a little bit of a touchy cartoon to use. I really wanted to use it for as far as what's going on with oil prices and what's happening there. But again, we're trying to have a little bit of levity because it is obviously a very serious situation. So here's a chart of the S&P 500, and you can see this particular chart. And what I've done is I've put some very important levels right here. So this is the end of January sell-off that we had, about a 5% sell-off in the S&P 500. We then had a rather nice rally, only to be followed by the decline as Russia invaded Ukraine. And we went down here and actually made a low a little bit more than 10% as far as the sell-off of the S&P 500 for the year. So now, again, we're trying to tell people that we are literally one headline away. And sure enough, as I make this video, yesterday we had one of the largest rallies since 2020, literally about a 2.5%, almost 3% rally up. European markets rallied 6 or 7%. So the question is the low in the markets, the S&P 500, happening right now? We think there's got to be some more time to tell. Again, we say to people, don't make any major investment decisions because you could have a rip-roaring rally like we did yesterday, and we're giving some of that back today. The other big news event out there is what's happening with interest rates. Now, I show you this again, and a lot of people don't understand why their bond funds are down. But this line in the 10-year Treasury shows you that yields really accelerated the first part of the year because obviously the Federal Reserve looks to be behind the curve with inflation. Now, the only thing that they can do is they can manage short-term interest rates. Next week is very important. We have a 2-day Fed meeting next week. We're going to get a lot of clarity. Already, Chairman Powell has said that he's going to hike at least 5 times this year, 0.25% each time. We're looking for at least the first 0.25% next week. We think that actually is going to be a positive for the markets, both stocks and bonds, because it'll give some clarity as to what's happening with interest rates this year. But I circled this area right here because the 10-year Treasury had accelerated up to 2%. And then you had the flight to quality trade, or what I call the fear trade, where when Russia invaded Ukraine, everybody bought treasuries. Well, lo and behold, the last couple of days, we've now seen yields float back up to 2%. And actually, the 2-year Treasury has accelerated to new highs for the year as well. Let me show you some other charts right here. Again, I was in Austin, Texas for a big investment conference. And a lot of us investment professionals have agreed that we think small mid caps is the best place to be in 2022. This happens to be the Russell 2000. Now, you can see that the Russell 2000 had a long sideways trading pattern, broke out in December, looked like it was going to take off, only to collapse back down below this trading range. Now, one of the reasons why we think that small mid cap stocks are really going to do well is for a couple of reasons. Number one, we think that large cap growth stocks, and again, this isn't a recommendation to buy or sell, but like Apple, Microsoft, Nvidia, Amazon, Netflix, Google, the darlings literally of the large cap space the last 5 to 7 years, we are beginning to see money come out of those stocks, and we think it's going to find a home in small mid cap stocks. Why? Number one, small mid cap stocks are extremely undervalued on a historical basis, especially in the biotech area. You have some biotech stocks that are trading below their stock prices, trading below the cash on their balance sheets. But we think the small mid cap area really has room to run in 2022 because they're able to pass along increased costs much more quickly as far as inflation goes. Now, those increased costs that they pass along means that they can raise their prices more quickly than many of the larger companies out there. And when they raise their prices, their margins increase, and those margins go right to a bottom line a lot faster. So for example, if you take a mid-cap company and it makes an extra $1 billion in profit, it has a lot more meaning than Walmart or Microsoft making $1 billion in profit, which is basically for many of those big companies a rounding area. So small mid-cap stocks is one of our favorite asset classes out there. We want to make a comment about crude oil. In a former lifetime, we used to trade commodities, and we've seen many markets go literally parallel, or I mean ballistic, or parabolic is really what you want to call it. And that's what we think oil has done. We're calling it right here. We were very bullish on oil last year into this year. We thought oil would hit somewhere north of 100. Obviously, it has, breaching literally $130. There was a huge sell-off recently in oil prices. They're trying to stabilize at these higher levels out there. But these parabolic markets, what goes up very quickly can come down very quickly. Now, that may not help the consumer as far as gasoline prices go in the long run, but at least it shows you there may be some relief in the future. So to kind of sum up our market comment for the first week in March, global tensions continue to roil the markets. We are literally a headline away from a 5 to 7% rally or a possible 5 to 7% decline. You can't make long-term asset allocation decisions, based upon what's happening in the headlines. However, our risk indicators are turning positive for U.S. equities. We run a tactical account. Our tactical account several weeks ago started to dip its toe into the equity water. It's at about 30% equities right now. If the market declines 5%, it'll go to 50% equities. Again, we are seeing sentiment numbers that are extremely bearish, where people are believing and investors are believing we're at the end of the world. Now, are we in a bear market? Most likely, I'm going to make some comments on that in the future. But if we are in a bear market, and if the bear market did start in February of 2021, which many believe, we could be at the end or closer to the end of the bear market. Now, again, we've showed this before and we'll show it again. Historically, global tensions in the stock markets and the bond markets don't really have any long-term impact on investment returns. They cause a lot of consternation. They cause a lot of buying and selling and whipping of the markets back and forth. If you really had to ask us what we think is going to happen, we think volatility is going to start to quiet down over the next couple of weeks. We think the markets are going to kind of trade back and forth until they want to see what's happening. And again, we think next week's a big week because they're going to be getting some clarity on the Federal Reserve as far as how many hikes this year and what the hikes are going to come as far as every meeting. Is it going to be 50 basis points, 25 basis points, et cetera? So remember, our final tagline is, you never want to be too bearish. You never want to be too bullish. That's all we have for this week. Thanks much, and we'll talk to you next week.